Welcome to Brandstorm, the podcast that talks to the people behind America's brands. I'm Dan Trzynski, president of Platypus Advertising and Design.
And I'm Nancy Christopher, PR director at Platypus. Our guest today is Doug Fox, managing director at Claremont Partners, a Chicago-based strategic communications firm that provides and executes sophisticated communication strategies which enable their clients to realize their valuation and reputation objectives. Thanks for joining us, Doug. Welcome to Brandstorm.
Thanks, everybody, and it's good to be with you today.
Give us a little background of what you've done in your career, Doug. Give us a history.
First, let me give you a little bit of insight and start with Claremont Partners. Claremont is a strategic communications company principally focused on issues related to public companies. We help companies communicate better with investors. A big part of our business is in the area of investor relations, in which we work with companies and our clients to ensure that their investor messaging resonates the right way with the investment community. And that would involve such things as helping them with press releases, presentations, conference calls, investor messaging, annual reports, you name it. Anything that really touches the investor, we're going to work with them, including increasingly their websites. Investors are increasingly going to the investor portion of company websites for their information. It's become really a vital tool to get the investor messaging out. Also importantly, we work with our clients on what we would call key issues that face them throughout their life cycles. As a public company, such things as you might have heard of shareholder activism or significant transactions or even crisis communications when that proverbial meteor, hits the plant. What do you say? How do you say it? And who says it? In a very real way, we work at the intersection of finance and communications, which might be a little bit different than a lot of the people you talk to, but it is really a vital role, particularly those in the public arena. For myself, I actually got my start on Wall Street as a stock analyst way back when at a brokerage firm. And then after about 5 years of that, I moved into a relatively new area called investor relations. And I joined what I would consider one of the pioneers in the IR field. And I've spent about half of my career on the agency side and about half of my career in the public company arena. And throughout my career, it's been very important for me to use my financial analysis skills to help companies formulate that right message that resonates the most with investors.
I would think your communication skills, Doug, go a long way with helping your investor relations clients.
I kind of think of myself actually as a financial analyst who learned how to communicate.
That's kind of leads me into my first question is, okay, when you are an investor relations person, what's your role in the branding process of a company? It seems like there'd be this natural right brain, left brain conflict of the financial side of it, yet I still got to be an effective communicator.
When you look at a brand, it's really important to think about your constituents. And very clearly, there's the consumer constituent that everybody's aware of. But particularly with public companies, there are a lot of different constituents. There's the public. There is the investor. And so that the whole branding process really has to involve all of those sorts of what we would call stakeholders in our field. Very much the IR professional or the strategic communications professional really needs to have a seat at the table in that process.
Doug, what's changed with the investment community? There's been an evolution over the past decades. What's the good and bad of that evolution?
Oh, man. I think you could put an entire podcast on the evolution of Wall Street over the past number of years. And there's been a lot of good and probably a lot of not so good. I think some of the major trends, a lot of it really driven by technology, has over the past 30 years or so, a lot really has happened. If you think about such things as more flow of funds onto Wall Street with 401ks or the evolution of investing in the retail versus the institutional investor and the rise of hedge funds over time, the rise of passive investing most recently, where interestingly, retail investors, people like you and me, are buying individual stocks less and less. We're buying passive funds, we're buying index funds, we're buying ETFs, exchange traded funds. We're not buying so much stock anymore, unlike, maybe 20, 30, even perhaps 10 or 15 years ago. I think every year we talk on Wall Street, we talk about how short-term everything is coming, and the long-term investor is kind of becoming a dinosaur. You have people today that are funds that are set up for ultra-fast trading, that even the length of an optic fiber cable comes into play in terms of how quickly they execute transactions. Electronic trading generally is much bigger today. Actually, a very small percentage of shares today are traded on actual stock exchange, and there are several venues there, they call them, in the cloud, which trade stocks off exchanges. I think very importantly, one of the things we're seeing recently is the rapid decline in IPOs and the number of public companies. There are about half the number of public companies today that there were 10 or 15 years ago. We're down to about 3,000 or 4,000 compared to over 7,000 maybe a decade ago.
Wow. Why is that?
Well, you have a flush of money coming into the investment world and the rise, quite frankly, of private equity.
Sure, venture capital, that type of thing.
Venture capital, private equity, all of those things are in many ways sucking up companies. The cheap money has driven a lot of merger and acquisition activity that may or may not have happened if interest rates were higher. So you have companies gobbling each other up as well. And on the opposite end of things, a lot of companies today are not using the public markets like they used to, where a company might have its IPO, its initial public offering, and use those first few years to develop as a company and to grow and give the public a chance to participate in that growth. Where today, if you think about companies that have gone public recently, they want to get to $10 billion market caps right away. They want to have that growth record already behind them before they get into the market. And some companies are just eschewing the public company generally because in many ways it's kind of a pain. I mean, there's a lot of cost involved in being a public company. You have the SEC and the various stock exchanges to deal with. You've got a broad range of shareholders. You might have 200 or 300 different institutional shareholders. A handful of them might be very important, large shareholders. You have potential for activism where the company could be bought out from under you because you have some guy in some town who may or may not know your company well. Generally, they know your company perhaps better than you know your company. They're very smart guys. But you have all of these factors, and it many times creates a quarter-to-quarter sort of performance mentality that you can't focus on the long term. If you think about a company like Panera, where one of the reasons why the CEO sold to a private equity said, I want to focus on the long term. I don't want to focus on the short term, quarter-to-quarter sort of things. Absolutely.
It can't all be about the numbers when it comes to, I want to get more to the communication side of things, especially you see all these internet and IPO companies. I mean, it was crazy in the 90s, but you're kind of seeing a resurgence of that again, where they get these crazy evaluations based on an idea. They haven't sold anything. They haven't made any money, but wow, the stock jump. One of them, like Roku right now, is like, okay, they just went out, they came out at in the teens and they went up to 50. Now they're down to 30. And it's just this crazy thing because that's all got to be about hype and communications, doesn't it?
Well, to use an old worn phrase, there's a lot of irrational exuberance on Wall Street.
Right.
I mean, think about Tesla, for example, where some of these companies capture the imagination to the public and they just go nuts because they use the product. People use the product in the house and they say, oh my God, this is the next Amazon, if you will.
Sure.
Well, interestingly, Amazon stock for a number of years was just kind of languished for a long time. Who wanted to buy books over the internet?
Right.
If you remember that.
Right.
And now Amazon is the king of the internet and the king of retail. And it's really changed the retail environment and how we buy things today. But there is a lot of that going on where it's happened with the dot-com bubble. It's happened throughout history where you have these boom and bust cycles as companies and the public in particular either are irrationally exuberant or irrationally pessimistic about certain things. One of the things that drove stocks down, particularly toward the end of the bear market in 08 and 09, was people just giving up, throwing their hands up in the air and saying, I can't stand the pain anymore. I got to get out. So it actually happens both ways. And I think for the smart investor, they're very observant and they're more dispassionate perhaps than the general public. And they see perhaps this irrational exuberance as a time to maybe sell into the strength. And perhaps like in March of 09, that unusual and over pessimistic environment to be an opportunity to go both feet in and make a killing in the market.
You had mentioned Warren Buffett. He buys brands that he likes and he uses. How does consumer advertising impact what happens in the investor community?
That's a good question. Yeah, fundamentally, a brand, whether it's Coke or Pepsi or what have you, is really an asset of the company. What is the value of that asset? And investors very much look at that, whether it's in the consumer space or in the industrial space. Companies that continually invest to cultivate their brand is very important, making sure that investors are aware of what their brands are and what they mean to the particular customer base. For example, we worked with a public company here in Milwaukee that put on an analyst day. And one of the things they impressed upon the analysts was the broad range of brands that the company has. In this particular case, it's an industrial company, and the corporate brand is very well known, but they have perhaps 10 different product brands, which are extremely important in the market in which they serve, but not as well known to Wall Street. And they spent a lot of time talking about the brands themselves. So I guess the short answer is that investors really do pay attention to brands. And it's extremely important, whether you're a consumer-facing company or an industrial company, if there's differentiation in your brand, what makes your brand and your products different than other companies' brands or different company products, that's very important to communicate that to investors.
You know, speaking of communications, you talked a little at the top of the show about the communications tactics that you use in investor relations. In my world of B2C, the press release, its value is being questioned these days, and certainly annual reports, I see fewer and fewer of those being done, yet you all seem to be in a time capsule where you are actually using these communications tools quite regularly still.
Press releases for sure. Press releases are vitally important. I think the debate is always, you don't want to flood the market with press releases that perhaps have little or no real meaning or import. My philosophy has always been that if you're going to issue a press release, make it important. Make it, it's not just about earnings, but if you're issuing a product release or something like that, make it important and make it, from my perspective, working with public companies, say why it's important to the investor. Why should the investor care about this? You know, not just the public, but if you're coming out with a new product, how does it advance your strategy as a company? How does it fill a niche that perhaps the market does not have and things like that? I think a lot of press releases that I read are very long on specifications of a product and things like that, but it really doesn't tell the story behind the product and what that means for the company. And I would encourage companies to spend more time thinking about those sorts of insights that you could provide, not just to the investor, but to the general public as to the value of a particular press release and a particular product or some sort of transaction that might be occurring or something like that. On the annual report side, I actually completely agree with you. Annual reports are a fraction of what they used to be.
Right.
With the advancements in technology, generally speaking, as soon as the ink, not even before the ink is dry on an annual report, it's out of date. Hence, the real drive for more real-time information on the website, on the corporate website, on the investor website is much more important these days. More and more companies are sending out either just their 10K, which is the SEC version of the annual report. They might do a wraparound with a letter to shareholders from the CEO or the president of the company. But companies, public companies, are definitely spending less on annual reports today for obviously good reason, but they should be spending more, quite frankly, on things such as their website to make sure that it's providing the right messaging for investors and the public, because that's really where more investors are going today.
And I absolutely agree with you on the press release, and the news media will thank you for your advice. So,
speaking about the public a little bit, you know, how does the retail investor impact how a brand markets their stock? You know, with Joe the plumber being able to trade stock now because of the internet with TD Ameritrade and all these online brokerages, you know, Wall Street's become very accessible to Main Street. Do the big companies, do the investor relation people, do they care about that individual guy or what they think?
I hate to say it, but probably less and less.
Right.
As I mentioned earlier, people like you and me are buying stocks less and less. We're buying ETFs, we're buying index funds. Even in my portfolio, you know, I grew up in the stock market, so I do own individual stocks, but the vast majority of my portfolio is in index funds and ETFs. It's just kind of the way that the world has evolved. It's much more efficient. You have diversification of your portfolio. If you have a hunch that you want to play a particular sector of the market, you don't have to buy one stock. You could buy a basket of stocks around a particular company.
Yeah, that has made it easier. And as Buffett says too, I mean, didn't he have $1 million bet or something like that on any of the hedge fund guys that could beat the S&P or something like that?
Yep. Yeah, that's true. I mean, just buying the S&P is good enough.
Right.
These days, I mean, the active managers are really hurting these days. It's sad to see. You've got smart guys out there who are being replaced by algorithms. You have a company called BlackRock, which fired a bunch of its large cap portfolio managers in favor of a computer, believe it or not. I mean, it's really quite amazing. Now, all of that said, I do see that the bigger B2C kinds of companies, think about P&G, think about Disney and companies like that, there is still a strong following of those companies among investors. Many times you hear of parents buying their kids a share of Disney stock when they're born and things like that.
Right.
A lot of that is still happening. Those sorts of companies are definitely still in the thick of things with regard to, having a very large retail or consumer base of shareholders. But increasingly, what we are seeing is that more and more of the retail investor is moving into funds rather than individual stocks.
Doug, I wanted to get your take on cryptocurrency. Mm-hmm. A lot of news about Bitcoin, blockchain. Is this all hype? Is it the real thing? What's your take?
Not to put you on the spot or anything.
Yeah, I know. I mean, had I known what these cryptocurrencies, what Bitcoin would have done, I would have loaded up when Bitcoin was a few cents a coin, and I could have retired.
Right.
A few months ago when it hit 10,000 a share.
It was almost 20. Now today it's down to 10.
Yes.
So as we speak,
absolutely.
What's
on
going
It's really
there?
In that throw of kind of what you were talking about. It captured the imagination of the public, and kaboom. It took off like a rocket ship. At the beginning of 2016, Bitcoin was $1,000 a coin and peaked out around 20,000. Now it's below 10,000. So you're getting that market volatility. I've been doing a little bit of thinking about it. If you think about it from a historical perspective, what has happened, not just in our lifetime, but over the millennia, where first people traded goods. I grew corn, you grow wool, let's trade. Then you had gold come in as perhaps a medium of exchange, and then perhaps coin of the realm. And even today, if you look at the US dollar and any other currency, it's what we would call fiat currency. It's really not based on anything other than the confidence that people have in using it as a medium of exchange. Maybe Bitcoin is that next generation. It's driven by technology. It's at least the blockchain part of the technology seems to be finding a home. But I only think time will tell. My observation on that also is that it could be generational. I work with a young man in my office. He bought Bitcoin. My daughter's boyfriend bought Bitcoin. I'm looking at it. I don't understand it, but I'm not alone. Like Jamie Dimon of JP Morgan says, what the hell is this?
I was actually at a dinner party the other day, and their 23-year-old son was giving us all lessons in Bitcoin.
Yeah, it's like programming your VCR or using your phone. I mean, in some ways, I do think it is generational. So could there in the future be this non-nation-based medium of exchange? Yeah, I think it could happen. In our lifetime, maybe, but only time will tell.
And you'll be there to communicate it.
Yes, absolutely.
Yeah, and explain it. What do you see? What does the next 10 years look like in branding companies to Wall Street and Main Street? You mentioned something a little bit earlier saying that they could do a better job on the website. Give us some insights. What information is missing? What could they be doing?
In my world, everything has to do with the valuation of a stock, which is you're buying an asset, you're buying a piece of a company. People may or may not realize that when you buy a share of stock, you are becoming an owner in that company, whether it's 1/10,000,000th of a share of a piece of the company, but that share of stock gives you ownership in the company. And why do people buy an asset? They say buy low and sell high because companies are the value proposition is that investors are always looking for three things. They're looking for growth, they're looking for improving profitability, and they're looking for a management team that are good stewards of capital, that they invest wisely to grow the value of the business, no matter whether it's a private business or a public company. Those are really fundamental. And to the extent that your company is focused on brands or has brands, you need to invest in those brands, because if you think about, again, like Amazon, that continually invested in its brand, and look at it today, it's an $1,100 or $1,200 stock, and it was, I think, about $8 a share when it came out. So I think we live in an environment today, though, that everything is just so hyper-focused because of the technology that there is a lot more avenues for brand development around such things as the web. Social media is becoming more important, not so much for the professional investor right now, but I do see a lot in terms of B2C sorts of companies using the likes of Facebook and LinkedIn, and I'm sure that there are other platforms that are equally important.
They might be wanting to get their message out on in those spaces on like corporate responsibility and those types of things. I mean, I saw that Fink from BlackRock wrote that letter last week about wanting to get a lot of the companies that BlackRock's investing in to be more socially responsible.
That is huge. The whole area called ESG, I think it stands for something like environment, social, and governance. The whole ESG movement is going to be a huge thing over the next several years, where you do have companies like BlackRock. I'm sure Fidelity and T. Rowe Price and some of the other big guys are in there, all about governance and social responsibility. It is a very interesting trend. And
well, it's what the young people, they're calling for it. They want it.
Yep.
It's important to them.
Absolutely. And the ability to use social media and other avenues to get that message out about what they are truly doing in those areas is really, really big. There's no question about it. As I mentioned, we just live in a plugged-in world today. And if you need information, or if you want information, it's literally at your fingertips. And companies really need to be aware of that. Having a website that is focused on the issues that are important to investors and the public. ESG, it's really vital to get that built in and incorporated into your messaging. And using social media today, whether it's your website, Facebook, or LinkedIn, or whatever other avenues are important to you and your constituency, really vital. I think the whole ESG movement, corporate responsibility, is going to be gaining momentum over the next several years. There are a number of investor groups that have formed, one around investor stewardship, that are really focused on these things. And they're not prescribing certain things for companies, but they are definitely providing guidelines for their investment. And I'm talking about companies that maybe 50 companies today have banded together, and they control something on the order of like $17 trillion in assets. So they have a voice at the table. There's no question about it. And guys like Larry Fink at BlackRock are saying to public companies, you have to step up. You have to do these things. This is really the wave of the future.
So if the website is that communication tool, obviously it's the communication tool of the present and going to be probably of the future. You mentioned something about, I want to invest in a company that has a good leadership team. Should companies be talking more about their people on the website versus just earnings and performance and what we did last quarter?
That's a good question. I think that there's room for some highlight of that. That's a good question. I don't have a good answer for you because I think from my perspective, making sure that the public knows who the management team is, what perhaps their capabilities are. But I do think fundamentally it does come down to performance.
I think so too. I agree with you, Doug.
Okay.
Well, there you go.
Final answer.
Right. There you go.
You mentioned Tesla earlier, and Ron Barron's is one of the biggest investors in Tesla. And he says, I don't care if the company makes money, doesn't make money this quarter, that quarter. I believe in Elon Musk. How much of, again, the people portion of, do you believe Bezos? Do you believe these guys, Zuckerberg? Are they worth just because it's them putting money behind them?
I think there's a lot to be said for the person behind it.
There is a lot to be said. If you look at Bezos, if you look at Amazon, they don't make money.
Right.
But my God, they're growing by leaps and bounds. Right. Could they make money? Absolutely. They could make money tomorrow if they wanted to. But the investment horizon for them is still pretty long. So they're investing their profits rather than harvesting the profits. And some people think that Elon Musk is that same kind of character. Clearly still in the startup stages with regard to Tesla and all of the other things that he's in, but there are believers and people are taking some risk and with the objective that they're going to get handsomely rewarded for that risk. Maybe they see certain things that the rest of us don't see, and that belief, perhaps backed up by some insight or some research that they've done, says, yes, this is the horse I'm riding. It's the Elon Musk thoroughbred in the Kentucky Derby, so to speak, and he's my guy, he's my horse, and I'm going to ride him to the finish line.
Well, it is a cool car. He's got to speed up production now.
Oh, I'm sure, like a lot of people, I've driven in a Tesla. They are cool cars. There's no question.
I actually got to ride in a Tesla when I summoned an Uber in Denver once, and I'm like, oh my God, what are you doing being an Uber driver? He's like, hey, I spent all this money in this car. I'm a software engineer by day, and I never get to ride it. So I figure if I'm just going to drive my car around at night, I might as well make some money doing it. So
that's awesome.
It was a pretty cool Uber ride, I'll tell you that.
That is awesome. Absolutely.
So, Doug, if there's any investor relations people or companies in the public sector that could use your type of help, how would they get in touch with you, and what does that type of engagement look like?
Sure. Anybody could contact me at Claremont Partners at dfox, DFOX, at ClaremontPartners.com. That's CLERMONT partners.com. We have a very robust staff. We are a senior-led organization. I would say that the average tenure of people leading the organization is probably around 20 years, actually. And our engagements are led by them. We don't put in the B or the C team. You get the A team, so to speak, all the time. We're doing some interesting
work. We do that here, too. We do that here at Platypus. You get the A team.
There you go. And we do it because we love it. It's a very fun sort of profession, and every day is different. It could be working on a press release one day and then dealing with an activist investor situation the next, or it could be a transaction the next day. It's really a very diversified environment that I think really from professional or personal perspective, you tend to use a lot of your right brain and left brain. There's a lot of analysis that goes on, but there's a lot of creativity involved as well.
Well, I can certainly hear your passion, Doug, and I'm sure your clients appreciate that.
Thank you.
Thank you so much for being with us today. And if you like what you've heard, our audience, please don't forget to share, review, and subscribe to Brandstorm.
Thanks, Doug. This is Dan Trzynski along with Nancy Christopher at Platypus Advertising and Design, an awesome company that creates perceptions that influence choice for a variety of local, regional, and even global brands on a daily basis. We hope you'll join us next week for another episode of Brandstorm.